gang, welcome back. Before we begin, let's do a quick recap from what we talked about in lesson 3. So gang, in lesson 3, I showed you why over 90% of traders fail. Remember, this is all about the 6 inches between your ears. I also showed you how my time with a trading psychologist changed my trading life forever. And finally, gang, we discussed the power of objective risk management and how this can help you develop your edge in trading. So what I want to do here, guys, I want to tie our first 3 lessons together and then move on into lesson 4. And gang, in my opinion, lesson 4 is one of the most powerful lessons of the 3. So what we've looked at so far, we've talked a lot about building a trading system, but now I want to talk about filters and, most importantly, position sizing. And what if I told you there was a way you could increase your profits by 200% taking the same trades? So here's what we're going to learn in lesson 4. We're going to talk about how to utilize filters to increase your average profit per trade, increase your win percentage, decrease your average loss per trade, and decrease your loss percentage. So again, you're going to learn how using a few 100% objective filters can have a massive impact on your trading performance. I'm going to show you a system that I'm finishing right now and how one directional filter and one volatility filter increase the system expectancy by over 200%. That's right, you heard me correctly. The system expectancy increased by over 200%. Then gang, I'm going to drive the point home even further, and we're going to discuss position sizing and how this can have a dramatic impact on profits if used correctly. Gang, in fact, here's a great example. Larry Williams, I'm sure a lot of you have heard of him. He won a worldwide trading competition using position sizing. He took a $10,000 account and grew it to over $1.1 million. Now, the system itself was only responsible for $100,000 of that gain. The position sizing, the other $1 million. Gang, you think this is powerful? You think this is something you should learn? This is pretty cool, isn't it? Okay, let's get started. So let's talk about some directional filters. So gang, what I'm going to show you is actually, it's real data from real systems that I've either tested or trades that I've actually taken. And I'm going to show you how powerful these can be. Let's go into the different types of filters first. So a lot of you who trade stocks, one of the most popular filters is the 200 period EMA. I'm sure a lot of you have heard of what they call the death cross. Well, that's when the 50 period EMA crosses below the 200 period EMA. So an example of this filter would be if the 200 EMA is sloping up, then you're looking for longs only. If it's sloping down, then you're looking for shorts only. So let's look at another example. Momentum filters. Some traders like to add momentum filters. An example would be using a MACD. Stands for moving average convergence divergence. So an example of that would just be if the MACD is greater than 0, then you want to be long only. If the MACD is less than 0, then short only. And then finally, gang, one of my favorites is what I call a volatility filter. Now, here's an example. Bollinger Bands. So the way Bollinger Bands work is they contract, means they spread out during periods of high volatility. They tighten or contract during periods of low volatility. So when price moves and it moves outside of those bands, that means you've had a large directional move. So you could say if price closes above the upper Bollinger Band, then no longs, because maybe the move is overextended. If it closes below the lower Bollinger Band, you could say no shorts, because that move could be overextended. It's just an example. So again, now I want to show you the PPT Pivot Trader system. I want to show it to you on the S&P 500 futures. I want to show you the impact that two filters had on the results. Okay, here's the data with no filters. Okay, it's just raw data, gang. 322 trades. $6,600 net profit. Now, keep in mind, gang, this is on a $7,000 account. The net profit still is pretty darn good. Win percentage, 39%. Profit factor, 1.17. What that means, gang, is for every $1 you put at risk, you expect $1.17 in return. And the expectancy with no filters is $20.59 per trade. So now let's look at the same trades with two filters applied. It's one directional filter using a 200 moving average, and it's one volatility filter using the ATR. Number of trades, 179. So we have 44% fewer trades. Well, gang, what that means to you, you're in the market 44% less. You're exposed to less event risk. What is event risk? Well, I'm sure you guys can imagine maybe one day we wake up and President Trump announces we're going to war with Russia. Or the Federal Reserve decides they're going to hit us with a surprise interest rate hike. Or, God forbid, gang, we have another terrorist attack. In addition, fewer trades means we're paying fewer commissions. All of these things are great as traders, right? So now let's look at the change in profit. Profit increases 86%. So not only do we have fewer trades, but we have higher profits. Gang, imagine, what's this going to do to expectancy? So now let's take a look at the win rate. 44%. It's a 13% increase. Let's look at the profit factor, 1.69. So for every dollar we risk, we're expecting $1.69 in return. That's a 44% increase. And finally, gang, you ready? Expectancy. $69 per trade. Gang, that's a 235% increase. Amazing. And gang, on a $7,000 account, this is 175% ROI. So now, let me show you some examples of the two filters. So I want to begin here with discussing the MA filter and how it's used, okay? Okay, I got a little laser pointer here. Okay, so the red, that tells you that your MA is bearish and you can take shorts. Your green, well, that tells you that the market is bullish and you can take longs. And then gray says that the MA is neutral. Well, what does neutral mean? Okay, gang, here's another one of those if-then thought processes. So follow along with me. If the MA filter moves from red to gray, then I'm still looking for short trades. What I actually call that is just bearish neutral. Okay? Make sense? If the MA moves from green to gray, then I can only take longs. I call this bullish neutral because that's when the moving average is in the process of possibly turning. So gang, let's take a look at this trade. So the system calls for a short on a close below the red line of at least 2 ticks. So 2 ticks below that red line, and I'd be shorting at the close of the bar. So notice here how the MA filter is on this bar right here, gang, goes from green to gray. Well, what does that mean? No trade. You see how easy this is, gang? The lines tell you where to trade from, and the filter tells you if you should be taking the trade. This is easy, isn't it? Now let's take a look at the volatility filter. So in this example, I want to be long once price closes above the pink line by at least 2 ticks. This bar was only 1. So let me walk through the volatility filter with you. Now pay attention here, please. If the closing price, which is this bar, minus the value of the line is greater than the ATR of this bar, no trade. Let's take a look. Here's the ATR in ticks of the prior bar. It's 6. This current bar closed above the pink line by 9 ticks. So there's no trade. So gang, we have taken a look at the power of filters and the impact that they can have. So now what I want to look at is position sizing, or what that means is increasing or decreasing the number of contracts that you trade per signal. Gang, when it comes to position sizing, I actually view position sizing and the trading system separate. So my system tells me where to trade, and the position sizing tells me how many contracts to trade. I no longer have to say to myself, how many contracts should I trade here? Do I feel good about this trade? Or I just had 5 winners in a row, let me double down on the next one. No. I let the position sizer tell me to increase or decrease my size. So let's take a look at the power of position sizing. Gang, ignore this at your own risk. See what I did there, gang? Sorry, I had to. Okay, before we get into this, I've got big news for you. Y'all ready for this? Congratulations. You've just won. You can either get $1 million right now, or you can get the distribution over time. You get a penny a day doubled for the next 30 days. All right, gang, I need everyone to play along here. Type a 1 in the chat if you want your $1 million now. Come on, who wants their $1 million? All right, gang, about half the room actually said they want that $1 million. So let's take a look to see how this plays out. So here it is, gang. A penny doubled every day for the next 30 days. So after 15 days, those of you who chose the $1 million must be feeling pretty good. Those who chose the penny, what were you thinking? You got $163. After 20 days, remember, gang, we're looking at the power of compounding here, okay? We're doubling each day. Now those penny people, they're at 5K. I bet you guys that got the $1 million feel pretty good. All right, let's look at the next 5 days. Oh boy. All right, gang, it's getting interesting now. So for those who chose the $1 million, how are you feeling now? Are you regretting it yet? Finally, gang, let's look at the last 5 days here. $5.3 million. Congratulations for those who picked the penny. You just made an additional $4.3 million. Gang, think about this. For those that wanted the immediate gratification, you just underperformed by $4.3 million. So gang, this is somewhat similar to that buy and hold strategy we looked at 2 days ago, 2 lessons ago, where we compared a buy and hold strategy versus the moving average strategy. If you remember, the buy and hold did 83%. And The moving average strategy did over 240%. Gang, it is these types of trading stats that are the most important to your trading success. So let's take this same approach and apply it to trading. So I just showed you the difference between the instant gratification versus the compounding returns over a period of time. And as you saw, the majority of you actually chose the instant gratification. You clearly saw that was the wrong choice. It actually cost you over $4 million. The reason I showed that is because that is the way that most struggling traders think. Gang, think about it. How often do you exit a trade early? Because you want that instant gratification. You exit at $100 versus waiting for the system target of $150. So I want to build on this now. I want to move this directly into what we do, trading. So I want to ask you, I got another question here, gang. How many of you would be happy if you could average $300 per week trading the Russell 2000 and oil? 300 a week. How many would be happy if you could average 300 a week? Now, from what you've seen with me, would you agree that you can average $300 per week over 5 trading days? Is that possible? Honestly, guys, from what we've seen this week, is it possible to average 30 ticks in 5 days? Yes. Now here's another question. Is it possible for you to replace your income after 1 year averaging $300 per week? Is that possible? Let's take a look. Now I want to move this into the position sizer. So gang, when you really focus on what I'm about to teach you, you're going to realize the power of money management and how averaging just 30 ticks per week can get you to a point where you can replace your full-time income. So take a look at this, gang. After 25 weeks, so about halfway through the year, you're now averaging $2,100 a week and trading 7 contracts. Now you started with 1 contract and $300 a week. Then by week 50, you're at 8 contracts, averaging $2,400 a week. Do you realize that $2,400 a week is actually over $100,000 a year? Now here's the other part of this. We only work about 15 hours a week of real trading time. That's not bad income for a part-time job, is it? Now, some of you might want to grow a bit sooner, so we could actually look at the position sizer every day and take our daily P&L and increase our size accordingly. Let's take a look at some real trades. So again, here are the PPT signals over the last 9 months. Now this is single contract performance, allocating $5,000 per contract. Getting us over $10,000 in profits. Over a 200% ROI. Now let's take this and add it into a position sizer. Now before I get into this, gang, let me talk about what the delta means. The delta, the bigger the delta, the more conservative the growth. So for example, a delta of 5,000 means I increase contracts after every 5K in profits per contract. So for example, to go from 1 contract to 2 contracts, I need to see 5K in profits. Then to go from 2 contracts to 3 contracts, I need to see 10K in profit. Because remember, I need 5K in profit per contract. And gang, this is an $18,000 increase in profits taking the same trades. We did nothing different. So one way to look at this is consider a contract to be like an employee. Because that's one of our themes in these lessons, is treating your trading as a business. So how much are you going to pay each employee? And how much work are you going to expect from them? After all, guys, this is your business. So here's the key takeaway. Every day you sit down in front of your charts, you do the same thing. You wait for the PPT signal. You take the trade. You place your stop and target. The only difference is you may be trading 3 contracts instead of 1. Remember, guys, we talked about Ron, who was trading 1 contract when we met, and now is trading 6. The only way he was able to do this is through generating profits in the PPT system. Now, what if we got more aggressive here and actually reduced the delta? Okay, so we're going to take a delta of 5,000 where we're trading 3 contracts and had an $18,000 increase in profits to a delta of 2,500, and now we're trading 6 contracts. Remember, gang, we decrease the delta, we get more aggressive with adding contracts. So we cut the delta in half and nearly tripled the amount of additional profit. Again, we made no changes to the system. What we do every day in the markets is exactly the same. The position sizer just tells us how many contracts to trade. It's based purely on a mathematical formula. No emotions. You know, like when you feel really good about a trade, so you add contracts. I mean, we've all been there, right? So again, let's do a quick recap on lesson 4. I showed you how adding a couple filters can have a massive impact on your trading profits. Then we looked at a specific example using the PPT pivot trader system, where we increased our expectancy by over 200% with just 2 powerful filters. Stick around, gang. I'm going to show you how you can get the pivot trader for free. Okay, gang. I also showed you how proper position sizing more than doubled the profits of the system by increasing the number of contracts traded. The key here is you must take all emotional decision making out of your trading, from the entries to the exits to the number of contracts you trade. You can't trust yourself to make those decisions in an objective way. You will fail. Gang, by now you should see the big picture from all 4 of these lessons. You must remove emotions from your trading decisions. You must have a rules-based system to enjoy long-term success as a trader.